Imagine waking up one morning to find gas prices have soared overnight, flights are canceled, and your electricity bill just doubled. No, it's not a dystopian movie. It's the ripple effect of a war thousands of miles away. When Russia invaded Ukraine in February 2022, the world didn't just witness a geopolitical crisis, it felt it. At the pump, in the market, and in everyday life. But here's the twist. The war didn't just spike oil prices, it reshaped the entire global oil market. So how exactly did a land war in Eastern Europe twist the arms of oil giants and rattle global economies? Let's break it down, layer by layer. Russia's power in the oil game. Before we talk about explosions and sanctions, we need to understand Russia's seat at the energy table. In 2021, Russia was the second largest oil producer in the world, accounting for 12% of global oil production. It was also one of the top exporters of natural gas. So, when tanks rolled into Ukraine, the world didn't just flinch at the violence, it braced for an energy earthquake. Countries dependent on Russian oil suddenly faced a hard choice. Continue buying and fund the war effort indirectly, or cut ties and risk plunging their economies into an energy crisis. Spoiler alert, they chose the latter. But the consequences? Oh boy, oil prices go ballistic. In the early weeks of the war, oil prices didn't just climb, they skyrocketed. Brent crude soared to $139.13 per barrel, the highest since 2008. WTI crude hit $133.46 per barrel. To put that into perspective, imagine your grocery bill jumping 50% overnight. That's exactly what happened to industries reliant on oil, from transportation to plastics to agriculture. A study using advanced analytical methods like VMD decomposition and multi-resolution causality testing found that the Ukraine war alone accounted for over 70% of the price fluctuations during the first 6 months. Brent jumped over 56%, and WTI followed closely at 52%. It wasn't just chaos, it was a full-blown redefinition of global oil economics. Two worlds, two markets, US versus Europe. Now here's where things get really interesting. While both the US and Europe felt the heat, the impact wasn't equal. In Europe, the pain was sharper. Why? Because Europe heavily depends on Russian energy, especially natural gas and pipeline crude. Cutting ties with Russia sent European nations scrambling for alternatives, facing higher import costs, logistical nightmares, and political backlash at home. Meanwhile, the US, thanks to its domestic shale production, had a buffer. It could produce more and even sell to Europe. But that didn't mean Americans were spared. Prices at the pump still hit record highs and inflation surged. So, the war created a tale of two oil markets, one surviving, the other struggling. Sanctions, speculation, and the Fed factor. Let's pause and clear the fog a bit. Many assume the war alone caused the price hikes, but that's only half the story. The real oil market is a tangled web of dominoes, and other players joined the party. Sanctions on Russian oil created supply shortages. Speculators in the market drove prices higher out of fear. And then came the Federal Reserve, raising interest rates aggressively. Higher interest rates strengthened the US dollar, making oil, priced in USD, more expensive globally. As the dollar surged, it offset some of the oil price spike. On September 27, 2022, WTI dropped back to $76.31, a sharp fall from March highs. So while the war pushed prices up, the Fed's monetary tightening pulled them down. Oil prices became the rope in a geopolitical tug-of-war. Beyond the headlines, what the EMC model revealed. To separate the noise from the actual war impact, researchers used a new framework called event analysis based on multi-resolution causality, EMC. Think of it as a high-powered microscope for market shocks. The model did something brilliant. It filtered out overlapping factors like Fed policies and USD fluctuations and isolated the war's pure impact on oil. Here's what they found. The war caused a net increase of $37.14 in WTI and $41.49 in Brent. It wasn't just a short-term spike, it altered the long-term price trajectory. The gap between Brent and WTI widened, reaching $12.64 at one point, revealing regional fragmentation in oil markets. This wasn't a storm, it was a climate shift. Volatility is the new normal. The Ukraine war didn't just trigger a spike in oil prices. It shattered the sense of stability the global energy market once relied on. Almost overnight, oil became one of the most unpredictable commodities in the world. Prices soared on headlines of escalated conflict, only to plunge days later when peace talks or diplomatic gestures hinted at resolution. Markets were no longer reacting to supply and demand, they were reacting to fear and speculation. This extreme volatility created chaos for industries that depend on oil. Airlines couldn't set ticket prices with confidence. Shipping companies saw fuel costs swing unpredictably. Even governments struggled to build budgets or manage reserves when oil prices refused to behave. It's like trying to steer a ship in a storm where the waves are being controlled by political headlines. And for oil-dependent economies, this uncertainty translated into inflation, currency pressure, and stalled growth. The Ukraine war made one thing brutally clear. Global oil markets are no longer just economic. They're emotional, political, and dangerously reactive. The era of somewhat predictable oil prices is gone. What remains is a new normal defined by instability, where even a rumor can cost billions, and where long-term energy planning feels like gambling in a war zone. Strategic shifts. How countries responded. No one wanted to be caught off guard again. The war sparked massive changes in energy strategy around the globe. 1. Diversification. European countries, especially Germany, started cutting Russian gas dependency by importing from Norway, the US, and even Africa. 2. Emergency reserves. Nations began tapping into their strategic petroleum reserves, SPRs, to stabilize prices temporarily. 3. Green energy acceleration. Suddenly, investing in solar and wind wasn't just environmental, it was strategic. 4. Hedging with financial tools. More companies started using futures and options to protect against price shocks. Every major oil-importing country took this war as a wake-up call. Energy security is national security. The battle for oil trade routes. While bombs fell on Ukrainian soil, another battle raged quietly over energy logistics. The war triggered massive disruptions in shipping routes, pipelines, and port access, especially in the Black Sea. Ukraine and Russia both play vital roles in the region's energy infrastructure. Russia's oil exports traditionally flowed through the Druzhba pipeline. But once sanctions kicked in, these routes became geopolitical choke points. European countries could no longer rely on easy or cheap access to oil flowing from the east. Russia responded by redirecting oil shipments to Asia, particularly China and India, often at steep discounts. In contrast, Europe scrambled to bring in oil from the US, West Africa, and the Middle East, causing shipping times and freight costs to skyrocket. The result? A fractured global oil logistics system. Tankers carrying Russian oil began turning off their GPS transponders to hide their origin. A new dark fleet of ghost ships emerged, quietly delivering sanctioned oil through shadowy channels. It wasn't just about supply, it became a cat-and-mouse game of oil smuggling, redirection, and creative rerouting. The war didn't just alter prices, it redrew the energy map. Former allies became competitors, and trade routes that were once stable are now volatile chess pieces in a much larger geopolitical game. Russia's oil gambit, weaponizing energy. Perhaps the boldest move in this oil drama was Russia's weaponization of energy. As Europe imposed sanctions and vowed to cut dependency, Russia hit back, shutting down or restricting gas supplies to multiple European countries, especially through the Nord Stream pipelines. This wasn't just retaliation, it was strategy. By restricting energy flow, Russia sought to create internal political pressure within the EU, hoping that rising energy costs would spark unrest and weaken the bloc's resolve. And it nearly worked. Across Europe, people faced rolling blackouts, factory shutdowns, and heating crises during the winter of 2022 to 2023. Governments were forced to subsidize energy costs, buy emergency reserves at premium prices, and even restart coal plants, rolling back years of climate policy in a desperate bid to keep the lights on. Germany, one of Russia's biggest former energy partners, had to rapidly shift from diplomacy to damage control. But weaponizing oil and gas turned out to be a double-edged sword for Russia. While they earned short-term leverage, it accelerated Europe's pivot away from Russian energy. LNG terminals were built at record speed. New contracts were signed with US, Qatari, and Norwegian suppliers. In the long run, Russia may have won the battle of energy shock, but lost the war of energy dependence. Once Europe restructured its supply, those lost customers won't return. The war turned oil into a tactical weapon, but it also reminded the world that reliance on any one nation's energy supply is a dangerous gamble. Lessons from past versus present. History is full of moments where geopolitics jolted the oil market. In 1973, the Arab oil embargo caused prices to quadruple, plunging the West into an energy crisis. The Gulf War in the early 90s sent oil futures soaring overnight. After September 11th, markets panicked, sending shockwaves through oil and commodity prices. But the Ukraine war introduced a whole new layer of complexity: hyperconnectivity. Unlike past conflicts where the impact was more regional or contained, today's world is deeply intertwined. A missile strike in Ukraine can lead to higher gas prices in Los Angeles, stock market drops in Tokyo, and wheat shortages in Africa. That's the ripple effect of globalization, and oil is its beating heart. What makes the Ukraine war uniquely disruptive isn't just the conflict itself. It's the scale of the economic warfare, the length of the disruption, and the reshuffling of energy alliances across the globe. We've seen countries that were once heavily dependent on Russian oil racing to build LNG terminals, sign new deals, and rethink their entire energy strategy. The past taught us that oil and conflict are connected, but the Ukraine war taught us something new. In a globally wired world, a local war can paralyze the entire energy system and change it forever. What's next? The road ahead for oil markets. The war taught us that oil markets are no longer just about supply and demand. They're about risk, reaction, and resilience. Here's what the future might look like. Oil prices will remain volatile as long as the war drags on or escalates. Energy independence will become a political priority. Green energy investments will accelerate, not just for climate reasons, but for strategic ones. Oil alliances may shift. Expect more deals between countries like China and Russia, while the West leans into renewables and friendly producers. The rules of the oil game have been rewritten, and there's no going back. So, the next time you fill up your tank or pay your electricity bill, remember, you're not just dealing with numbers, you're feeling the aftershocks of a war shaking the world's energy core. The Ukraine war didn't just change borders, it redrew the map of global oil. If you found this breakdown valuable, help us spread the word. Like, subscribe, and hit that bell icon so you don't miss future deep dives into global finance. This isn't just news, it's your world, your wallet, and your future.